So our first speaker, I'm going to go ahead and let him mic up. This is Stephen Cawiezell, and I just found out a couple minutes ago that he's been vacationing like 45 minutes from me. Had no idea I was down on the Alabama coast, and he was over in Pensacola, Florida. And I find Pensacola, Florida, a lot of people have been there, and I don't know if it's military or if it's passing through or what it is, but Pensacola seems to be a very, very, very hot spot for us. All right, well, you can go ahead and mic up, Stephen. If it'll let you, let's see, I might have, there we go. I'm going to make you a presenter, make you an organizer. Check. There you go with that mic check. What? I heard you.
All right.
Does it sound clear for everybody? I got one out of several hundred saying issue with the sound. So I'm just making sure that it might be Jack and not us. Jack, hit a refresh on your side. Maybe it's you. There he is. There's Stephen. Good morning. How was your trip?
It was great. It was great. It feels good to be back. We were down at Pensacola Beach and drove through Mobile yesterday, so I love the intro music as I was driving through Alabama yesterday. But long drive, 11 hours, but I've been up. I've had plenty of coffee, so I have been looking forward to this. I love talking about this stuff.
All right. Well, I can hear you very clearly, and I can see your screen. So the mic is yours. You have 1 hour.
Awesome. Thank you so much. So again, my name is Stephen Cawiezell. I'm the head publisher at TradeThirsty.com. Today, we are going to cover how to use moving averages to achieve big returns. I love moving averages because they're simple, they're easy, everybody can use them. You don't need any fancy indicators or special tools. So we're going to have a lot of fun, a lot of rules-based stuff. So you definitely probably want to shut off all distractions and get a piece of paper and a pencil if you haven't already, because I'm going to give you some key takeaways today. Okay, so my big promise to you is by the end of this training, you have a simple, easy to follow process on when to get in and most importantly, when to get out of any stock or ETF that you trade. No second guessing. So I'm going to give you the rules. I know that's a big promise, but I'm a rules-based guy, so I like to give simple approaches that you can follow and that you can use yourself. Real quick, I'm going to throw in a disclosure myself just to make the lawyers happy. I'll give you a quick 15 seconds to read that. Okay, that might have been 10. But in this presentation, I'm going to show you why moving averages are the best tool for trend following, how to use moving averages to protect the downside, and I have Drawdowns Matter, and we're going to talk about that, how to use a rules-based approach for moving averages, and why I like to use directional ETFs over stocks most of the time. So this is the kind of trading system we're going to talk about. This is the kind of process we're going to talk about. As you can see, this goes all the way back to 99. A lot of growth versus just a buy and hold on the S&P 500. So we're going to cover all of this today. Just real quick background about myself. So I like to add a human element just because sometimes we're behind the computer all day. Don't want to sound like a robot. I bought my first stock at the age of 14, and really the rest was history. I fell in love. I work in a small working class town of Russellville, Arkansas with my wife and my 2 kids. I have a background in economics and finance and worked for one of the largest broker-dealer firms in the country for 6 years. Now, as far as my trading history goes, I'm a former financial advisor turned trader publisher. I worked in a practice with 60 million assets under management. I'm the author of Expert Trading Systems, which was the #2 ranked on Amazon downloads in that space, and the head publisher and founder of TradeThirsty.com. And, I like to show this because I love my family. I have cute kids, but, we all have our why. Why do we do this? Why do we trade? Why do we want to be financially independent? And for me, this is it, right? This is my wife, Stephanie, my 2 kids, Graham, who's now 5. I think this picture might be a little bit old, maybe a year old, and my daughter, Madeline, who is 7, and then, of course, myself right there. So, it's just very important sometimes to take a step back, understand why you're doing that so you can put in the work to be successful. So I'm going to hit you with a gut check question right off the bat. What is your biggest trading challenge? What was the first thing that came to mind right then? Okay, because I know what mine is. I'm going to tell myself here in a minute. But, maybe you have trouble taking a loss, right? You don't want the market to tell you when to get out. Maybe you take profits too early. Now, I have right here, the smiley face, the old Stephen, right? That was my problem. I fixed it. thinking the market is always against you. Maybe you put too much emphasis on your entry and ignoring your exit strategy. We're going to talk about that too. Everyone thinks, the holy grail is of entries. Well, I'm going to talk about why exits matter. Don't have sound money management rules. Don't know how to put, how much to put into each stock. It really all boils down to don't have a trading plan. And I define the trading plan as something that's written down, a written set of rules with the kind of setups you like, your enter, your exit strategies, your objectives. When you write something down, it makes it real. So I ask you, do you have a trading plan that you review from time to time? So my biggest challenges, I'm going to go back to the old Steven, was mishandling a winner, right? Like I found myself selling stocks too early, and I really just needed a process and a system, a rules-based approach to say, okay, I have no problem picking winners, but I used to have problems staying with winners. And, we're going to talk about a rules-based approach to keep you in those big winners. So we're going to solve most of your trading problems today by showing you a rules-based approach that anyone can follow. And again, I know that's a big promise, but I truly believe in the whole, KISS analogy, like you have to keep things simple. And I believe most of your trading problems, and I found that most of my trading problems are just very, very simple tweaks you can make that can move mountains in your portfolio. So let's cover that. So once you follow this rules-based approach, you're never going to allow a small loss to turn into a big one. Never sell a big winner too early. Never be confused about how to play a stock, because you will have a written set of rules, a trading plan to help you make a lot of money, and just as important, keep you from losing a lot of money. Now, I'm a younger guy, but I still consider myself a more conservative trader, right? I like to cut my profits, I like to cut my losses short and let the winners run. So, I consider myself conservative, where I like tight stops, or I like a reasonable stop, and I'm not going to let it go down and take my money down with it. So if you haven't by now, go ahead and get a pen and a paper ready, because this is when we're going to start to get in some rules-based stuff. Real quick, I do want to cover what a moving average is. I know it's a pretty novice definition, but I wanted to make sure for some of you novices out there that I'm crystal clear on what we're accomplishing here. So a moving average is a widely used indicator in technical analysis that helps smooth out the price action by filtering out the noise from random price fluctuations. That's according to Investopedia.com. Really, it's this, right? You have the NASDAQ, and this is the NASDAQ as of last year, and this is just a great textbook example. You have all this wild price action, right? All the ups and downs, all the volatility, all the big bars, the green bars, the red bars, and then you have a smooth moving average really to tell you the direction of the trend, okay? It's just that simple to plot. So that's why I like it. I like it because it's simple, but it's easy to plot in your chart. It's not going to add too much noise, and there's a lot of things you can do with it. So I'm going to cover why moving averages are the best tool for trend following, because they're simple. Institutions use them, and they allow you to take advantage of the rallies. We're going to use it as a trailing stop. So again, let's go back to simplicity, right? Just a smooth line, right? It's a very, very simple chart. You get your price action, you got one indicator. That's it. So that is a very simple. You can use it as a stop loss, right? You can use it as a trend following indicator. It's just very simple and easy to follow. Any broker it's a free indicator. You can use it anywhere, will allow you to use this. So going back to the simple, right? I like to keep things simple. I don't like to add a lot of extra indicators and a lot of extra noise to the price action. I'm a price and volume guy. So, you have a MACD, PPO, stochastics. I know a lot of people that use these, and I'm not saying you cannot make money with them. I know a lot of professionals that use them and know how to make money with them. But, my philosophy is you should be able to make money with the price and volume action first. Because if you can't do that, then this is just noise. This adds more confusion. It adds more variables to the overall picture, and it makes it harder. So I'm not saying, again, you can't master this stuff, but it just adds more stuff, right? I like to keep things simple. So, and you can see, take advantage of the rallies. Why moving averages are good for trend following? It helps you take advantage of the rallies. Like, look at this rally. This is just ETP. This is just a good example of why a moving average, can find support and why institutions use these to support their stock. Look at all the times this stock right here, 1, 2, 3, 4, 5, 6, 7, 8 have found support at a 50-day moving average. I do like to use the 50-day moving average a lot, but you can use the 20, you can use the 200, but institutions will step in, and I say institutions, the pensions, the mutual funds, really the smart money. They don't want their stock going below a certain level. So a lot of times they will look at these places on the charts as an add-on, right? You can see this support right here. That's not you and me. That's not the retail trader. That's the big money really flowing into this. Okay, so supporting a stock, that's a great time to get on board, because when you see this volume spike, that's an institution or a pension or a mutual fund that's stepping in and supporting the stock. You can buy right here and then see how the trade goes. So this is just a consolidation, but man, I see it time and time again with growth stocks. They will continue to find support at moving average areas in a reasonable environment. Obviously, in a bear market is quite different. But again, let's just go back to take advantage of the rallies, okay? So this is a great example. Ignore all the buy and sell. We're going to cover that here in a little bit. But I mean, look at some of these rallies, right? You have a strong stock. It's going to rally above the 20-day moving average. And then when it needs a little deeper breather, it might come down and find support at the 50-day moving average, and then continue higher until it breaks the 50-day moving average, and then you get back in, right? And then it rides the rally line. I call the 20 EMA the rally line, okay? So it'll ride the rally line in a strong rally, and when it needs a better pullback, it should come into the 50. Now, bad markets, most stocks are not going to hold, but for the most part, it's going to keep you in. If you have a rules-based approach to moving averages, it'll keep you in, and it's incredibly simple. You don't need a fancy algorithm or any special indicators, right? You just buy right, sit tight, let the moving averages work for you. Now, I talked about drawdowns matter. So I'm a big, I really believe in protecting capital to the downside. When I entered the financial industry in 2007, not the best time to enter. I was in money management, and what I saw in the summer of 2008, where the market was down 7% one day, many times over, I immediately thought about, okay, surely there are some strategies that we can put in place to protect these downsides. So just to put this in a perspective, and why I think it's so important to have a conservative strategy to protect your assets on the downside, to make sure you're not going to sit through another 2000 to 2003, 2007 to 2009, where it was just cutting you in half, 50%. A 10% loss, that's pretty normal. Most of us are going to sit through that in a year. Needs an 11.1% gain to break even. A 25% loss, you need a 33% gain to break even. A 50% loss, you need a 100%. You need a double just to break even on that 50% loss. This is why we use stops. This is why we use moving average. I hope none of you are down here and have had an 80% loser. You need what Peter Lynch calls a five-bagger, right? You need something to go up 500% just to break even on the 80% loss. How many of these do you see in a given year? Probably not that many. Okay, so it's important to try to keep our losses up in here so we can reasonably make them back. I always say, let's just live to invest another day. If the market's not right or your stocks aren't acting right, just do what you have to do, protect your capital, live to invest another day. So this is just a simple approach that I'm going to put some numbers behind it, but over the last 20 years. But I just want to show you how powerful certain moving average strategies can be. So some of you have heard about the golden cross and the death cross, okay? So I just back tested and said, okay, over the last 20 years or so, what would have happened if we would have used the golden cross, death cross rule? And to be clear, you have the 50-day moving average, right, is the blue line, and the 200-day moving average is the red line, okay? So when the blue line crosses under the red line, when the 50 crosses under the 200-day, That's considered the death cross, okay? You would have been out at the very beginning of 2008. You'd have sold right here, and you would have avoided all this mess. All that mess. I talked a lot of people off the ledge during this time, not literally, but there were some hard times in 2008. But this death cross happened. You could have got out right here and with some longer term holdings and got back in when the golden cross happened, right? So now the 50 is back above the 200-day. You buy right here and you're getting in at a lower price, and you're avoiding all this whipsaw, all this nasty action you could have avoided in 2008 just simply using a golden cross, death cross rule. Here's the golden cross. Here's the death cross. You sell when the death cross happens, and you get back in when the golden cross happens. Whatever happens in here doesn't really matter. You're just really trying to avoid the whipsaw, right? You're trying to avoid it. And if we go back to the slide drawdowns, right? If this is a 50% decline, which this is, you need a double to break even, right? This looks a lot better. You're not only getting out somewhat towards the top, you're getting in at a much lower price when it's safer. So you don't have to have a double to break even. So let's put some numbers to this. Okay, going all the way back to January 1st, 1999 to the end of 2018, December 31st, okay? So that's 20 whole years worth of data. If you would have bought and hold the SPY, right, that's just with dividends, that's the S&P 500 ETF, your compound adjusted rate of return would have been 5.5%. Not great. I mean, it could be worse, but you would have sat through two 50% declines, okay? Max drawdown of 55%, right? The win ratio and the number of trades doesn't matter because you're fully invested the whole time. So average rate of return is 5.5%, buy and hold, and that's just buy and hold ETF. If you'd had a mutual fund, you probably would have done worse because the fees are higher. Max drawdown of 55%. Now, what if we just say, okay, I'm just going to have a simple rule with some of my ETFs or some of my longer term holdings, mutual funds, and say when the death cross happens, I'm just going to get out of the way, okay? So if you would have followed this approach, just a simple approach, you can do this yourself. You don't need me. You can do 7%, a little bit over 7% rate of return, which is more in line to historical averages, 7-8% during a lost decade. But your max drawdown, look at the difference between your max drawdown. The worst drawdown you would have had is down 18.5% versus 55%. This is what I try to do. Which one would you rather have? Make a little bit more, you're down a lot less, okay? And that's the goal. And a lot of times why this number is much higher than the buy and hold is because you're not having to play from behind like the previous chart we talked about. You're not having to get a double, right? You're getting back in at a better price. So I like small drawdowns, I like to protect capital, and I like to get double-digit growth. We're going to talk about the double-digit here in a second. Now, this golden cross, death cross happened 9 times in the last 20 years, okay? 66% win ratio. So 7 of the 9 were winners, 2 of the 9 were losers, okay? You would have been in the market, so exposure, you would have been in the market 73, so let's call it 74% of the time. So that means in the last 20 years, you would have been sitting out 26% of the time, fully in cash, just letting the market roll over, do its thing. At the same time, you're protecting your capital, you're protecting your drawdown. So this is just a simple process. So, and then I plotted this on a chart. Say, okay, if I would have started with $100,000 and bought and hold the SPY, see these nasty declines, right? And it still came way back. Where would I be at the end of 2018, 20 years? $293,000. What if I just would use a simple golden cross, death cross rule with the same SPY? Okay, $393,000. $100,000 more just by making 9 trades over 20 years versus a simple buy and hold. And any charting service will allow you to do that. Which one would you rather have? Because look, when this 55% decline happened, from the tech bubble to the bottom in 2003, you're flatline, you're in cash, you're fishing, you're doing something fun. Maybe you're watching the market, but you're not stressed about the market because your capital is way up here. Now, when it's time to get back in, look, you're still way up here, and then you can take advantage of that where the S&P 500 is just playing catch up. And that's what happens in these declines. You're flatline. Some are not that big. You're flatline, and you're just, and the S&P 500 has to play catch up. So if you just follow that one simple strategy, that's an extra $5,011.70 every year. 100 grand, 5 grand a year. 100 grand over 20 years, 5 grand a year. That's some income right there. Not bad. This is a heat map of the crossover. Okay, so this is from, and you can see what it's done every year. You can see the months. You can see the max drawdown. So in 2018, this strategy was up 1.61%. That's better than the minus 5% that the S&P 500 was down, and the max drawdown was 10%. That's a lot better than the max drawdown of 20%. So again, you know, you are not having to play as much catch up. So out of 20 years, this simple strategy, you'd have been down 4, and all the 4 down years were very manageable, right? 2000 to 2001, sitting in cash, not a single trade for 2 years. I know that takes some patience, but you know, those were some really, really bad years. I think patience helps, so you can live to invest another day. And then when you get back in, start to get some double-digit returns, right? Some big years. It's nice. You can do that. So when I stack them up side by side, the buy and hold versus the crossover, you can see you would have had 3 almost double-digit down years versus down 4% for the whole 3 years. Okay, 2008, down 4.87% versus minus 37%. Okay, it did underperform in 2011. That probably was your whipsaw, and underperformed in 2015. But if you can sit out the big ones, and if you can sit out the big ones in the bear market in 2011, I mean, that is my strategy, right? Protect, you get more income, you get more growth. So now there are moving average rules that you can use with individual stocks, right? So right here, let's just look at bandwidth for a second. Let's come back to this chart. So, you know, I think everybody would probably agree, even if you're an intermediate, and you say this is probably a breakout, like this is a big volume bar right here. This is where I'm getting in. And you could just have a simple rule. Say, okay, if it's a strong trending stock and it's going to trend above the 20-day moving average, you can say, okay, I'm going to sell half when it breaks the 20-day moving average. And I'm going to sell the other half when it breaks the 50-day moving average. Because you can see you are selling half, right? You're taking some profits, but you're letting the rest run, okay? Because it came down and found support at the 50-day 3 times after that, and then finally it broke. So here, you're out. So you buy here, sell half here, average gain somewhere in the middle. But then you get another breakout, okay? Sell half and when it breaks to 20, and it'd be still in the 50. I'm sure this rolled over with the market in the 4th quarter, but this is just a really good textbook example of the kinds of strong stocks you want to look for, and how you can use moving average for profit-taking rules, and how you can use it as a trailing stock. So here's a rules-based approach for some stocks. You know, you might want to just take a few notes. And my goal is to give you ideas, so conservative ideas, so you can put together your trading plan, right? So you can limit your drawdowns and maximize your upside, okay? So let's just look at 3 time horizons, because we're not all the same, right? Some people might like really short-term swing trades, and, you know, I probably would put myself more in the intermediate camp. I like to look for, even though I have some long-term positions, but I like to look for stocks that I can potentially hold until it breaks the 50. So just a simple rule of thumb, right? And again, you can adjust these to yourself, but let's say you buy a swing trade and you buy that volume bar that we just looked at, right? You're going to buy right here, okay? So we're going to put a 1% stop under that bar, all right? Target 1, 5%. That means you sell half at 5%. Target 2 is when it breaks the 20-day moving average. This is for really strong stocks that move very quickly. You can adjust it to 7 or 8%. You can adjust it to the 50-day moving average. My goal, you know, what might be good for my trade plan might not always be good for yours. So I think it's important for me to really give you some key takeaways so you can create your plan. You might be more of an intermediate trader, which is just kind of me right here. You know, I might have a 7% stop loss when I buy a single trade. And target 1 of 10%, sometimes it might be 8. So I'll sell half at 8 to 10%, and then I'll just let the rest run. I'll let the rest run until it breaks the 50-day moving average. I'm trying to give it more breathing room, right? Because you got to have some big winners in your portfolio to really outperform the market. So what I look at is okay, I need several big winners in my portfolio to really help me outperform for the year, so that I have to give them a little bit of room to breathe. And if you're longer term, more Warren Buffett style, you can use a wider stop loss at 10% because you might be wrong, right? You still want to buy it right. Maybe your target one is 25%, and maybe you let it run until it breaks the 200-day moving average, okay? So once you hit your target one, you raise your stop to break even on the remaining shares. So I hit my 10%, I raise my stop up to break even on the remaining shares. That way if it rolls back over, I'm at 0% gain on the second half, I'm netting 5. Right? 10% on one, 0% on the other, I'm netting 5%, right? You're protecting your stop, but you're also allowing it more room to run, okay? So what can make stock selection a little easier? Well, I like to use directional ETFs. I like a rules-based approach that anyone can follow. So there are a lot of variables that move stocks, a lot of variables that move an individual stock. You can look at, I see that someone says it's freezing real quick. I wonder, does anybody else have a freezing screen? Or, okay, I'll assume it's just your internet, no freezing. Okay, good. Okay, so all of the variables that move a stock, and I think that's very, very important to understand. You have to be right on a lot of things. Earnings are going to move a stock. Sales, institutional buying and selling, the smart money. What industry it's in, what sector it's in, because up to 50%, 40 to 50% of a stock is going to move by the overall sector, right? What sector it's in. Is that sector strong? You got price and volume, you got management, new products, new competitors, all things that can move a stock, and you still have to have the market direction right, okay? Still have to have it right. Well, what if you say, okay, maybe I take a little bit more of that money and invest it in directional ETFs. So if you have a rules-based system where all you really need to know is the market direction, okay? Look at all the variables you need when you're investing in individual stocks, and look at all the variables you need when you're investing in ETFs, because all this is already cooked into a basket of stocks. You don't need to worry because it's diversified, okay? There is a simple choice here. And again, I like to use moving averages because they're simple. I like a rules-based approach to directional ETFs because they're simple. I think that so many people look for the holy grail, right? And they add all these fancy indicators and all these extra tools, and they continue to search because it doesn't work for them. I think it is very important to keep things simple. So don't get me wrong. I'm making the case for ETFs, but I still love stocks. I trade them all the time. It's just harder. It really is. Whereas you only have to get the market direction right if you have a trading system, a rules-based ETF approach. Okay? So I love stocks, but the reality is you have to be right a lot. And that's just the truth. So why not take a portion of your money and invest in directional ETFs versus continuing to try to trade the overall stocks? Now, let's move over to the directional ETF side, okay? So I have done this, I've developed a trading system, and you can use the 20-day EMA for signals, right? So if you have some buy rules, you can say, okay, I just want to sell when, let's just say the NASDAQ or the QQQ is going to break the 20-day EMA. So the good thing is if you use a 20, you're going to be in for the strongest rallies. The downside is the shorter time frame you go, the more whipsaws you're going to have, because look right here on this rally, right? It broke, you had to buy it back. It broke right here, you had to buy it back. So, and this was when I initially started developing this several years ago. I was using the 20, and I would get some of the strongest rallies, but I'd get some whipsaws, and it would cost me. So I said, okay, what should I do to kind of back that out and just give it a little bit more room to breathe? That way the stop is not so tight. So then I said, okay, why don't I use the 50-day moving average? And I do use a simple moving average on this to give it a little bit more breathing room. Okay, so we're looking last year, this was when the market cracked, the start of the bear market, but you can see right here, coming out of May, you had some strong rallies and it came down. It would have broken the 20-day right here, or broken, excuse me, but it found support at the 50. Right here, even though it did break, you could have gotten right back in on this bar, came back, found support at the 50. So a lot of times when the 20-day moving average isn't working, the 50-day just gives it just a little bit more room, a little bit more breathing room, so you have less whipsaws. And I think that's incredibly important because I found in the strongest rallies, you want to use the 50. You just want to give it a little bit more room and not cut yourself off where you're having to buy it back all the time. That was a problem in 2013, and that's when I started to adjust to the 50-day. So I've developed a NASDAQ, a QQQ ETF trading system that covers 3 entry rules, 3 exit rules. I use price target for half and I let the rest run. So I have a price target. Once it hits price target number 1, then I let the rest run just like we talked about. This is the part of my trading plan. I only use price and volume of the NASDAQ. That is it. And some moving averages. It's very, very simple to use. And when you use price and volume, it's more likely that the trading system has sustainability because people can, throw all kinds of fancy indicators and curve fit to make the numbers look great. I think price and volume is a little bit harder to do that and has more sustainability because, people's emotions have not shown to change over the last 100 years in the market. So it's just price and volume of the NASDAQ. Don't trade bear markets, no fancy special indicators, just rules. So let's look at the performance. I want to show you the difference between using the 20 and the 50-day. Okay, so going back to from April 21st, 1999 to present, because that's really when the QQQ started. So we take our signals on the NASDAQ and we buy the QQQ, okay? So if you use a 20-day EMA as a stop, right, your compound adjusted rate of return is 10%. That is still really good. If you remember, the S&P 500 was 5.5%. So you almost double the S&P 500. Now, max drawdown of 17%. Win ratio of 52%, an average trade of almost 7 trades per year. Here's the interesting thing. The goal of this trading system is to only be invested when the market is in an uptrend, right? Sideways and the downtrends, I just want to sit out. I want to protect my capital. I want to get back in at a lower price. So you're only in the market 34% of the time. So over the last almost 20 years, you'd only been in the market 34% of the time. It's a very patient strategy, but as you can see, it's almost double the market. So I said, okay, what if I back it out and use a 50-day moving average? Give it a little bit more breathing room. Use 20-day EMA, 50-day SMA. Compound rate of return is 10.5%. So that is better, right? 0.5%. When you're compounding that over 20 years, that'll make a big difference. But look at the max drawdown. Right? The max drawdown, I got it down to 12% just by using a different moving average because this is going to have more whipsaws, right? And that's the max drawdown. That's not the average drawdown. That's the worst drawdown, peak to trough, over a 20-year period. The win ratio was better because, again, you're not having whipsaws, 59.18%, but you're also having less trades, almost 5 trades per year versus 7 trades a year because it's keeping you in, right? You're giving a little bit more breathing room, it's keeping you in, and that gives you more exposure. So you're in the market with a 50-day moving average 37% of the time over the last 20 years. So really, this is designed to keep you in the market the strongest 1/3 of the time. So you can see right here, the 50-day moving average system did a lot better than the buy and hold, the SPY. A ton better. Okay, 722,000 versus 272,000. Which one would you rather have? Okay, because you got a rules-based approach, and it keeps you mostly flat during the bad bear markets. That way you can build on it and take advantage of the rallies. Okay, so that's an extra $22,782.78 per year earned versus the buy and hold for the SPY, dividends reinvested. That's an extra per year. That is a huge, huge amount. Okay, so now let's compare them all because I continue to like to add more things and say, okay, what happens? So go back to the buy and hold. 5.5% for the SPY versus the crossover, 7% for the 50, the death cross, the golden cross, versus the 50-day moving average system of 10.5%. max drawdown 55%, max drawdown 18%, max drawdown 12%. Win ratio is not applicable because it's buy and hold, 66%, 59%. So it did dip, but I'll take that dip for a big jump in average rate of return and a big jump in decline in the average drawdown, okay? 98 trades. So this is, again, about 5 trades per year. You're only invested 37% of the time. But if you would have started in 1999 with these 3 systems, buy and hold, you have 293,000. Crossover, 393,000. QQQ 50 SMA system, 722,000. Which one would you rather have? You can have the one that does better, that has less drawdowns, it does have a lower win ratio, but you're only invested in 37% of the time. Historically, over the last 20 years, you're investing in the uptrends, and that's the idea. Protect the downside and maximize the uptrends. So how did we do in 2018? Well, you can see in 2018, the buy and hold in the SPY was minus 4.5%. That's what it did for the year. The max drawdown for the SPY was 19.5%. That means if you had $100,000, it was down to almost $80,000. Versus the 50-day moving average system, we did 11%. So that's a 15.5% outperformance, and the max drawdown was 5.57%. How did it outperform so much, and how was the drawdown so low? Because we're getting out towards the top when it starts to break the 50-day moving average. Anything that happens under it, we're just moving out of the way. We're protecting our capital. So this is the heat map over the 50-day moving average QQQ trading system over the last 20 years. You see it started in April. 2001, it was completely in cash. 2008, it was completely in cash. Lot of green. We did have, in the last almost 20 years, you did have 2 down years that you could see. I will take that. That is a lot better than buying and holding the SPY and having the SPY down 35% in 2018. I'm sure a lot of people would have preferred to be down 0 versus 35%. So this is what it's done every single year, and I have over here the max drawdowns because, again, I want to put an emphasis on that. I want to put an emphasis on the max drawdowns because you are not playing from behind. You do not have to make as much on the upside. That's going to help your income. That's going to help your overall return. I get asked this question all the time. It's the first question. Hey, Steven, what if I took your trading system, the 3 rules, and I just slapped some juice on it and use a leveraged ETF, the TQQQ? Well, you can do that, and I do that sometimes. Obviously, it's a double-edged sword. You can make a lot more money, but you're going to have bigger drawdowns, okay? So you have to be willing to balance those out and see which one's right for you. I could only test that going back to 2010 because I like to use accurate data, and that's when the TQQ was started. So start with same 100,000. The SPY would be at 222,000 versus 1.181 million. Versus a leveraged ETF system, okay? So obviously adding more juice, there's more upside, right? But then again, there's a bigger drawdown. So you just kind of have to make the decision. But yes, you can do this. You have to be willing to stomach sharper drawdowns. Just want to make that clear. So if I do compare the QQQ to the TQQQ, going to the end of 2018, 10.5%, average 32%. Now this isn't apples to apples because this is taking me to, this starts in 1999 and this starts in 2010. So it's not an apples to apples comparison, but I wanted to show you as far back the numbers as I had to, to show you. So pretty comparable. You're going to be in that 55 to 60% win ratio. But again, this is 2010, so you would have been exposed 47% of the time, almost half of the time, in the last 9-10 years, okay? There is a big difference, right? But I just like to show the disclosures too. But at least half of the people go with this route, right? But I clearly share with them the disclosures. So I do use 3 entry rules, and I'm just going to share one of them today. It would just absolutely take too long. But I just want to show you how simple some of the rules I use are, and I use different exit algorithms to really get me out of the market, and I think that's important. Everybody wants to know the entry, but from my studies and from what I've learned here recently, the exit strategy has a huge component on how you're going to do. I tested 3 exit algorithms and came up with the best one. So rule number 1 is just a simple reversal, just a simple reversal in above average volume. So the price action has to be under the 50-day moving average, and you got to get that reversing candle, just one simple daily candle, close under the previous, or undercut the previous week, close above the previous week, and above average volume. I don't have the volume bar here yet. And then you just buy at the open. Put a stop under here, and then we have our price targets and our moving averages, okay? So again, I like to use price and volume because that just makes it simple. And Chris Parker, to answer your question, this is one of the rules to determine if it's an uptrend, okay? So I have 3 buy signals. All of the buy signals can happen under the 50-day moving average, but I have a price target 1 that I sell half, and then, or if it doesn't hit that, I do use the 50-day moving average as a trailing stop, okay? So if I'm in an uptrend right here, I'm taking a profit along the way, and when it breaks this, I'm giving it plenty of room, would have kept me in this whole trend, take some profits right here, and then I'm out, okay? So it's just very simple rules. There's a few other nuances, but I like simplicity. So again, I kind of want to recap. So the QQQ trading system, I use 3 entry rules. I use 3 exit rules. I use a price target for half, and I'll let the rest run. I only use price and volume of the NASDAQ, and I trade the QQQs. I don't trade bear markets. I'm sitting in cash. No fancy special indicators, nothing extra you need to buy, just rules. I've been trading this and working on this for years, and I think based on what happened last year, it definitely proved its worth its weight in gold. I had a lot of happy people. So you can follow the rules and let your money compound, right? Or you can take the growth as retirement income. And I did one other study I want to show you real quick, and then I'll really open it up for Q&A. When I was a financial advisor, we talked about the 4% withdrawal rate. You might have heard your financial advisor talk about that. And that's a rule of thumb, and what that means is if you can take 4% of your overall portfolio and you'll never run out of money, okay? Not even when you're 100, you'll never run out of money. Well, I think I can do better. So I said, okay, what if I would have started with $100,000 and used a 6% withdrawal rate and then gave myself a 3% cost of living adjustment every year? So start with $100,000. This is an income plan. Start with $100,000, withdraw 6%. That's $500 a month or $6,000 a year. Increase it 3% every year with inflation. So year 2 would be $515 a month. Year 3, $530. Year 20, $876. So you're giving yourself a pay raise on top of the 6%. So this is what it would look like, right? So the monthly income, you can see every year would have gone up. The annual income would have gone up 3%. So you start with $100,000. The total withdrawal over the last 20 years, you could have withdrawn $161,222.25. Now, if I would have followed that rule and gone with a 6% withdrawal rate plus cost of a living, I still would have beat buy and hold. So you start with $100,000, you take out $161,000 over 20 years, and you still have $296,000 versus the same $272,000 taking nothing out, buy and hold versus S&P 500. Okay, so if you want me to send you these rules for you, here's my offer to coach 20 of you. So if you want to get the trading system and alerts, okay, so the email and text alerts for the buy signals, that's a huge value of $697. The complete rules to the trading system. So this is not a black box. You're going to know the rules. I'm going to teach it to you. You're going to feel comfortable with it. I'm going to teach you the complete trading system as well as give you the alerts. That's a huge value as well. So all historical trades in the members area, I put every single trade in there for transparency purposes. So you can see it. If you're a nerd like me, you might want to study them. I like to see historical trades. So I put all those in the members area for all eyes to see. Advanced training on the trading system. So I do have some more advanced training on the trading system. I cannot go through everything today, but I wanted to show you, give you one of the rules and kind of show you my style and my strategy so you could do it yourself. So as well, every week I put out a top swing trade ideas video. Now, this is my top 10 stock picks, and I add this because there are times where we're not trading. The market might be in cash, but maybe a couple stocks are moving. So I still like to swing trade around the core portfolio position. I look at the QQQ trading system as my core portfolio, and then I'll swing trade satellite positions around that. Okay? So everything is included today. So today it's just going to be $679 for 12 months. That's 72% off the suggested price. But you know, I talked to Silas and Jeanette, and I wanted to do something very special for you guys. They told me to do something very special for you guys. So for the next 20 who sign up, I want to give 6 months free. So instead of $679 for 12 months, that's going to be $679 for a 18-month subscription. So you use the coupon code 6FREE. That's the equivalent to $37 a month. $37 a month for 18 months, but you do have to pay it out at the $679 rate. So you can go to https://tradesplan.com/TradeThirsty. Be sure to add the S here because it is a secure order form. It is a secure site. If you would like to order and if you would like to be a part of the first 20, go to https://tradesplan.com/TradeThirsty. Excuse me. Coupon code 6FREE. This coupon code will be on the second page of the order form. So on the first page, you get your name and your email. You go to the next page, and then there's going to be a spot for a coupon code. It's once you enter this coupon code and hit apply, it will turn that 12-month into an 18-month. So you will, as long as you want to stay for, it's an 18-month subscription. 6FREE. So if you want to be a part of that first 20, by all means, go ahead. If you're on the fence, you can get an extra 6FREE if this is something that you want to do. I do have a 2-part guarantee. So trade it for 60 days, and if you don't love it or decide it's not for you, simply just submit snapshots of your trades, and I will issue you a full refund, no questions asked. If you don't make money for 6 months, I will personally coach you until you do. I like to add that because I'm very confident that if you trade it for 6 months, you will do just fine. We did just fine last year. We beat the market by 15%. And just to kind of show you, this is the rolling periods. There have been 232 6-month rolling periods in the last 20 years. 72% of them have been profitable. And as you can see, the further out you go, the higher the win ratio is, right? Out of 6 months, the best 6 months performance has been 47%. The worst has been -5%. That's good risk reward right there. Now, I get that's the best, but if that's the worst 6-month drawdown, that's what I'm trying to do. So you keep it, you love it, you keep it, you make money with it. You don't submit your trade log, you get your money back within 60 days. You have absolutely nothing to lose. And as an extra bonus for the next 20, in addition, I also want to give you access to my brand new traders group. This is where you're going to have access daily to me if you want to ask questions. I have people that ask me to look at chart setups all the time. I'm going to post daily chart analysis there. We make more trades and additional trades, and this is really a place to analyze your wins and analyze your losses too. Like, well, what I have done differently. This is a learning education group to really help you to get you some extra swing trades to trade around your core portfolio and a place to get a trading plan put in place. You need some extra help from me, that's where you will find me daily. And this is just a snapshot of just some of the people, Greg right here, my first trade paid for my subscription. It's always nice to start off with a win for sure. Congrats. Jeff, he wasn't a TQQ, so was I. Our last trade of the year, last year was in November, and it actually did really well right before the market rolled over. So this is just a snapshot. We have a lot of fun in there. It's a place for great camaraderie. So kind of go back here. Now, if you haven't already, go to the tradersplan.com secure order form /TradeThirsty. I'm going to get to a Q&A in a second. Coupon code 6FREE. That 6FREE is on the second page of the order form. Click apply, and that'll turn the 12-month order form into an 18-month order form. Okay? So I just wanted to show you, here are the 2018 trades. You can see right here, we did have 7 trades. This is where we did 11% last year, and the TQQQ, I always want to do one shorter, did 28% last year in 2018, the full calendar year. So we had 4 out of 7 were winners to get the 11%, but the losses were really, really small. So that's all the trades for 2018. I'm going to hit these FAQs, and then I'll look at your questions because I know we're running short. Got about 7 minutes. So these are just most common questions I get asked. Can I short when a signal sell? You can. I tend to be a bull. I haven't extensively back tested that yet. Okay, so if you put in a very specific set of rules, profit take and exit, you could do that. You could make money. You could go on the short side, trade SQQQ if you want to. But I do not send out short signals. I used to trade them, and what I found out is they added a little bit of growth, but they added a lot of drawdown. It really wasn't worth it. Can I trade options with this? Absolutely. Most people, I'd probably say half of my students, they take the alerts and they just trade options with it. I'm not an options trader, but they talk about spreads and everything in the private traders group. How much do I need to start? I think the most important thing to do is to get started. I mean, that's really up to you for the trading system. You might want to have $5,000 to $10,000. You can trade smaller. If you can just take my swing trades if you want to, and trade smaller with that. So what do I do when the system isn't cash? Easy. We swing trade, right? This is where if there is opportunity out there, I'm swing trading growth stocks to add that alpha to the overall portfolio. Can I take retirement income from this? Absolutely. I just put together a retirement income plan for you, the 6% plus 3% cost of living adjustment. So you can kind of rewatch that if you want to. Why is the subscription 12 or 18 months? This is a longer term trading systems, okay? So I offer this on 12 and 18 months. I don't offer this on a month-to-month basis because we might have 2 months where the system does not trade at all. And the question is, are you going to want to sit through that? So I'm looking for longer term thinkers, maybe earlier future retirees that are just really looking to put some of their money in something a little bit more conservative that's going to get growth but not a lot of the drawdown, or people that are even younger that are looking to accumulate assets, make sure they don't sit through another 8. Okay, so let me kind of get through some of these questions. Where to learn the system? Okay, so you just go into the members area. You would have to, let me kind of go back here. So this is where you want to go to make the purchase. And then in the members area, you're going to have full access to the advanced training for the system, the historical trades. Plus, I'd be happy. I usually do welcome calls with people just to make sure they're, doing what they're supposed to be doing and see if there's any questions. Is your system include contra ETF? No, I really just trade the QQQQ. That's me. It's just what I've always been used to. I'm a NASDAQ kind of guy, so it's a more aggressive approach than the S&P 500. So I figured if I have a system that tells me the best third of the market when to get in, I want to get a little bit more aggressive. Do you do trades during bear markets? I do swing trades. The trading system, if the 50 is under the 200 day, I'm in cash, right? That's kind of our filter. I use TOS. How do I get a trade log? How do I get a trade log? I'm not sure the question of what you're talking about. You can access the entire trade log in the members area, or you can go to this page and make your investment, and then you can see it. Can I see the drawdown chart too? I'm not sure which drawdown you're talking about. Let me kind of go back a little bit. So is this what you're talking about? So you can see the max drawdowns right here. There's really only one of 10%. Can I trade forex with this? I haven't tested for. I'm not a forex trader, so I couldn't speak to that. How many ETFs do I track? Well, I track 250, but I really just trade the QQQ. A lot of people ask me about the Russell 2000. I have very specific buy signals for the NASDAQ. You can trade the S&P 500 with those signals. You're going to underperform over time because it's not as aggressive. I don't recommend trading the Russell 2000 just because it has a mind of its own. Sometimes it can diverge from NASDAQ and S&P 500. So I'd really focus on the NASDAQ. But if you want to diversify, you can add the S&P 500. I'm having a hard time bringing up your plan. You might be on the wrong page. Let me kind of go back. Can I go back to the order page so I can drop you a link? So you got the trader's plan here. Let me add this for you. Oh, there you go. She answered that towards the end. I'm not sure what the question that is. On average, how many signals do you get weekly? Well, on the trading system, I might get 5 a year. So it's a pretty conservative strategy. Swing trades, I might do 1 a week. I've done a lot this year. I've probably done 25 from this Christmas. So we're very active on that. What's the difference between the 267 annual plan and what's the offer here? The 267 is the swing trades only. It is not the trading system, okay? And you do not get access to the private traders group with the 267. So 267 is swing trades only. You don't get access to the trading system. You don't get access to the private traders group. Thanks, Steve. Have to go. Thank you, Dorette. What would be the renewal price after a year? So if you use this coupon code 6FREE, you have 18 months. So it will not renew for 18 months, and it'll be $679. So $679, 18 months if you're part of the first 20. Yep, I think I answered that. Can I see the drawdown chart again, please, towards the end? I think I just showed it. I might have to go back. Try to go back to show you. So that is the max drawdown for the QQQ trading system. 2 losing years. 1 was basically a break even. 1 was down 5%. A lot of green. In the last 20 years, 90% of the years have been winners. Okay, thanks. You're very welcome. Any other questions? I think I have 1 minute. Jeanette's about to have to take over. Do we have any last questions that I didn't cover? Seeing some orders come in. That's awesome, guys. Again, if you want to take advantage of the first 20, you can go back to the 6-month free. Go to thetradesplan.com/TradeThirsty. 6 free coupon codes on the second page. I can't click the link for some reason. Why don't you try typing it in? Let me kind of see here for a second. Let me see if I can drop it in for you. And there's a link. It should be good. There we go. Yep, HD. Okay, new trader here, but I can understand your systems fairly well. Also, will this work for me? Yeah, I'd be happy to get on a phone call with you. It depends. I mean, I put a plan for growth, as you can see, from 100,000 to 722,000, and you have a retirement income strategy. Take 6% every year, and you still end up better than buy and holding. D. Scott. No, I mean from the webinar. I'm not sure what you're talking about. I think I have to go. Jeanette, if there are any more questions, I want to be respectful of the next person's time. If there are any more questions, maybe Jeanette, you can ask Jeanette, or she can forward them to me. It's just, I appreciate it, guys. Thank you very much, and look forward to hearing from you.